According to the Small Business Administration, 20% of businesses fail within the first year, and 50% of businesses fail within the first 5 years. But what they don't tell you is that these failures aren't due to bad products or services. Typically, they're due to financial mistakes that I see businesses make every day. I'm Jared with Ledger and Code, and in my 7+ years of helping businesses across construction, legal, and real estate, I've identified 5 critical mistakes that I see kill businesses quite frequently. And more importantly, I'm going to show you how to prevent those mistakes. Stick around to the end, and I'll share a free tool to help you audit your own business to identify these issues. Mistake number 1, mixing personal and business finance. Here's what happens. You start your business, you're bootstrapping, so you use your personal credit card for business expenses. Maybe pay some business bills from your personal account when cash is tight. It seems harmless, but it creates a financial nightmare. The real consequences? You lose valuable tax deductions because you can't track business expenses. You have no clear picture of your business profitability. You're personally liable for business debts. Come tax time, you're scrambling to separate months of mixed transactions. Here's how you fix it. Step 1. Open a dedicated business account today. Not next week, not next month, today. Step 2. Get a business credit card. Even if you're a sole proprietor, this separation is crucial. Step 3. Set up a monthly transfer from business to personal for your salary. This is how you pay yourself. Step 4. If you've already mixed funds, don't panic. Start separating from this point forward and clean up the past systematically. Tools you're going to need: a business checking account, business credit card, and accounting software like QuickBooks to track everything. The bottom line, your business is not your personal piggy bank. Treat it like the separate entity that it is. Mistake number 2, confusing cash flow with profit. This one kills profitable businesses all the time. Here's the confusion. Your P&L shows you made $50,000 last month, but your bank account is empty. How is that possible? The problem: profit is what you've earned on paper. Cash flow is what you actually have in the bank. You can be profitable and still run out of cash if your customers pay slowly or you have large expenses due. A contractor friend of mine had his most profitable year ever, $200,000 in profit, but he nearly went out of business because $150,000 of that profit was tied up in unpaid invoices. Profitable on paper, broke in reality. The solution? Create a simple cash flow forecast. Here's how. Start with your current cash balance. Add expected collections by week. Subtract expected expenses by week, and look ahead 8 to 12 weeks. Here are some warning signs to look out for. Customers consistently paying 60+ days out, large seasonal swings in cash flow, relying on credit cards to cover regular expenses, deferring payments to suppliers. The fix? Implement payment terms that work for your cash flow. Offer early payment discounts. Set up automated payment reminders. Consider invoice factoring for large receivables. Track both profit and cash flow separately. Your business depends on it. Mistake number 3, the set it and forget it approach to finances. I see business owners only look at their finances at the end of the year when they're doing taxes. That's like driving with your eyes closed. The set it and forget it trap. You set up QuickBooks, maybe hire a bookkeeper, and assume everything is fine until tax season. Meanwhile, problems are building that could sink your business. What to review monthly? Profit and loss statement. Are you actually making money? Where are costs increasing? Balance sheet. What do you own versus what you owe? Are receivables growing? Cash flow statement. Where's your money actually going? Key ratios: gross margin, current ratio, receivables turnover. Industry-specific focuses for contractors would be job profitability, equipment utilization, change order impact. For law firms, You're looking at realization rates, collection ratios, time utilization. And for real estate investors, you're looking at cash-on-cash returns, vacancy rates, and maintenance cost. Here's a time-saving tip. Schedule a monthly financial date with your business. Same day each month, 1 hour max. Review the numbers, identify trends, and make adjustments. Here are a few red flags to watch out for. Decreasing gross margins, increasing receivables as percentages of sales, growing payables, declining cash balance trends. Don't wait for problems to become crises. Monthly reviews catch issues while they're still manageable. Mistake number 4, treating invoicing and collections like an afterthought. This is the fastest way to strangle cash flow. Here are a few cash flow killers. Sending invoices weeks after work is completed. No clear payment terms. No follow-up system for overdue accounts. And accepting net 30 when you need cash faster. For construction, progress billing delays, change order disputes, and retention holds may cause issues. In the legal field, time entry delays, billing realization issues, and client payment resistance. And in real estate, tenant payment delays and maintenance dispute holds can all cause issues. The solution? Automated systems. Invoice immediately. Set up systems to invoice as soon as work is complete. Clear terms. Net 15 instead of net 30. Early payment discounts. Automated reminders. Email sequences for overdue accounts. Multiple payment options like credit card, ACH, and online payments. For a follow-up strategy to invoicing, on day 1, send the invoice. Day 8, send a friendly reminder. Day 16, if they still haven't paid, send a firm reminder. On day 23, give them a phone call. At day 31, it's time for that final notice. And at day 38, you need to contact a collections agency or seek legal counsel. Tools that will help: QuickBooks Payments for online invoicing, FreshBooks for service businesses, automated email sequences, and credit card processing for immediate payment. You're not being aggressive by asking for payment. You're being professional. Mistake number 5, flying blind without key performance indicators, or KPIs. Your P&L will tell you what happened, but KPIs tell you what is happening and what is about to happen. Beyond the basic P&L, most businesses stop at, did we make money this month? But the real power is in the metrics that predict future performance. Here are a few universal KPIs. Gross margin trends, customer acquisition costs, customer lifetime value, cash conversion cycle, working capital turnover. In the construction industry, you should look at job gross margin by project type, equipment utilization rates, change order percentage, and safety incident rates, which affects insurance costs. In the legal industry, you should be looking at billable hour realization rates, collection percentage, case profitability by practice area, and time to billing. This should always be under 30 days. In real estate, you want to check out your rent roll growth, maintenance costs per unit, vacancy rates by property, and cap rates by market. A simple tracking method is to create a one-page dashboard with your top 5 to 7 KPIs. Update weekly or monthly, track trends, not just numbers. Decision-making framework. What does this KPI tell me about my business health? Is this trend positive or negative? What actions can I take to improve this metric? What's the leading indicator that predicts this KPI? If your gross margin is declining, don't just cut costs, look at the leading indicators. Are you discounting more? Are material costs rising? Are you taking on lower margin work? Track the metrics that matter, not just the ones that are easy to calculate. Here's a bonus insight. All 5 of these mistakes are easier to avoid when you have systems that work together. When your project management software talks to your accounting system, you get real-time job costing. When your CRM integrates with invoicing, you can track customer profitability automatically. When your time tracking integrates with billing, You reduce realization rate issues. In upcoming videos, I'll show you exactly how to build these integrated systems. The goal isn't just to avoid mistakes, it's to build systems that make success automatic. If you want to audit your own business for these 5 mistakes and more, I've created a small business financial health checklist that is a step-by-step guide to systematically go through your entire business and identify issues that are costing you time and money. The link is in the description below. Which of these issues hits closest to home? Drop a comment below and let me know. I read all of the comments and it helps me plan future content. If this was helpful, hit the like button and subscribe. Next week, I'm going to dive deep into job costing for contractors. You don't want to miss it.